Welcome, educated homebuyers. We have a great conversation for you today. Jeb and I are joined by Lance Lambert, the CEO, co-founder, and editor-in-chief of Resi Club Analytics. He has an extensive background in real estate data and analytics. Lance has worked at Fortune, Realtor.com, and Bloomberg News. On today's show, we cover a number of critical topics. Lance goes through the March payroll data and CPI data that we just got today and what that means for the future of mortgage rates and affordability. He goes deep on the concept of supply and demand equilibrium and what that tells us about the future of U.S. home prices. Lance gives us key insights into the lock-in effect and how long we can expect low inventory levels to last here in the United States. We go through Lance's proprietary inventory tracker tool where subscribers can look at inventory trends down to their local market throughout the United States. We always talk on the show here about how all real estate is local. On the show, we discuss local market variations and price trends comparing Austin, Louisiana, the Gulf Coast of Florida, Southern California, and several other markets throughout the United States. We look at what those regional differences can tell you about your market. We finish up with Lance's thoughts on the state of journalism and media, particularly how the pursuit of clicks can sometimes lead to misleading representations of the housing market. It's a great conversation with valuable insights for homebuyers, homeowners, and investors alike. We hope you enjoy it.
All right, so Lance, a moment ago, you mentioned throw you some curveballs. So we actually found you or got you on the camera on a day where we got CPI data. I know you don't track CPI per se in the numbers that you're looking at and the data that you track, but a lot of what's happening in CPI is affecting the housing market in many ways. So is there anything that you want to, kind of just throw out there with regards to what happened today with CPI? How that might affect the housing market kind of as we progress and what the Fed decides to ultimately do with rates.
Yeah. So the thing to always remember, and, I like to bring this up all the time, which is the Fed has a dual mandate, which is maximum employment and stable prices. Right now, unemployment, the rate is very low. The labor market, while it has softened, it's not broken. It's still, very low unemployment. And on the inflation side, yes, there has been disinflation as we've rolled over from the biggest jump in prices, right? But the overall inflation rate is still above target. It's still above the 2% target of the Fed. And so there's still going to be an emphasis on fighting inflation. Now, that doesn't mean that, the Fed might decide to cut a little bit on rates, right? But I doubt, at least in the short term, there's going to be a big pullback in rates because while the Fed might decide to back off a little bit, that inflation is still there, right? And the labor market hasn't broken. So the idea that we're going to see a really drastic pullback in rates, it just seems unlikely in the short term, given just where the macro picture is at the moment. And the housing sector has seen an itty-bitty, a smidgen of relief by the fact that the spread between the 10-year Treasury and the 30-year fixed mortgage rate has pulled back a little bit from the biggest widening in the spread last year. But still, it's very, very high. I checked it today. It was like 270 basis points. So a 2.7 percentage point spread between the 30-year fixed mortgage rate average and the 10-year Treasury yield. So if that was where you would normally historically expect it, which is somewhere between 1.5 and 2 percentage points, the average 30-year fixed mortgage rate today would be closer to, let's say 6.2, 6.3%. And so we haven't seen much relief on the mortgage rate front, and we haven't seen there's still the expectation of higher for longer. And higher for longer doesn't necessarily mean that rates can't come down a bit, but it means given where the macro picture is, where unemployment is still low, and there's still slightly above target inflation, there's still an expectation that, rates could stay higher for longer.
Lance, in the last 4 business days, we got the 2 really good looks. Fed prefers PCE, but the market has been trading CPI more than this. We got CPI today. We got non-farm payrolls for March last Friday. And I have seen reporting in multiple places calling it a blockbuster jobs report. And you look at it and there were 0 jobs created from in the 25 to 54-year-old cohort. So yeah, there were a lot of jobs created, but part-time jobs, low-paying jobs to people that are not the drivers of the economy. So we still keep getting these headlines that say, hey, everything's great. But you dig into the numbers and it's definitely a mixed bag. We're not losing tons of jobs, but
Yeah, yeah. So I think there's absolutely a truth to the fact that the labor market isn't gangbusters, right? There's been a cooling in the labor market, and people can see it, right? It's not exactly the 2021 job market, but what you don't have is a considerable pullback in labor, right? There's not a huge number of job cuts. You don't have unemployment soaring, and so this place where we're at, which is we're kind of just moving along, but we're not seeing a considerable pullback in labor. If you stay in that place for a while, the Fed will lean into its target of inflation, right? And we're still above target there. So yeah, it'll be interesting to kind of see how it plays out. And I do think the headlines definitely get overplayed in terms of, talking about how hot the labor market is. I wouldn't call it a hot labor market.
You can't paint it weak.
Yeah. Well, I would classify the labor market as softening is how I would describe it. Softening from where it was in 2021. And it's kind of been a gradual process to get there. Now, some sectors have softened more than others, especially like the mortgage industry and some of the subsectors throughout the housing sector, in particular, the rate sensitive side of the economy. But that's how I would classify it as softening. And, a lot of my focus isn't on the labor side. The only reason I care about it is just because I'm all resi and housing, and it's an important part of the cycle and impacts the resi and housing side.
Well, let's actually talk about something you do care about. So we often talk on the channel, real estate's local, right? And often comes down to supply and demand, right? Rates affect affordability, but more so than anything, supply and demand are what's going to drive housing prices, going to drive sales. It's going to drive everything going forward. And one thing you do have and you pay really close attention to is an inventory tracker, which covers basically every market nationwide. Now, we're in Southern California, and between multiple channels that I have on YouTube and I'm often talking about Southern California housing market, but the comments lead people to believe I'm talking about the entire United States when I'm talking about, hey, look, our housing market is still really strong here. We don't have a huge amount of supply, and demand is keeping up at the moment with supply. So we've got stable prices, and prices really kind of moving up month over month. Now, we do see headlines, going back to the headline idea, with states like Florida, states like Texas, starting to see inventory up back to like 2019 levels. So maybe explain to the listener, Lance, what is the inventory tracker? Why is it important? Like really what you should be paying attention to when it comes to that type of data.
Yeah. So my view of active listings and inventory months of supply is I actually don't view it as a supply metric. I don't view it as a demand metric. I view it as the equilibrium of supply and demand. So you take a market like Austin. Everywhere across the country, when mortgage rates shot up, there was a decline in the number of new listings going on the market. The number of listings entering the market fell as mortgage rates shot up because there was essentially a lock-in effect where a lot of people at 2%, 3%, 4% mortgage rates who might have otherwise sold their home and bought something else, that turnover in the market was pulled back because rates shot up so quickly and affordability deteriorated. So all across the country, the number of listings hitting the market fell, right? Austin, though, they saw that, but inventory rose. So inventory rose in Austin despite the amount of supply entering the market falling. So how did that happen? It's because demand pulled back so much harder in Austin because there was a decrease in the pandemic migration from California and a lot of these other high-cost metros that was coming in 2021 into 2022. And as that demand pullback happened, and the fact that Austin saw a bigger run-up in prices, that bigger run-up in prices made it to where affordability for locals was more strained from fundamentals than other markets. So that helped to push down demand even more. So think of actives and months of supply can also be like a traffic jam, right? Where if everybody hits on their brakes and not as many cars are pulling off of the exits, you can build up. And so that's what happened in Austin. Despite the number of resale listings not rising, it actually fell. Active shot up 300% and back to pre-pandemic levels because demand pulled back so hard. So actives and months of supply, I really view as the equilibrium for a market. And one thing to note that's important for housing economics is that if demand pulls back, but supply also pulls back, if that demand curve moves together back, prices can continue to rise. That's just like what you're seeing in Southern California. There's fewer listings in California and there's fewer buyers in California. But because both have pulled back, the equilibrium for that market has stayed in a place where prices are still rising. And months of supply in Southern California in particular is very low right now. And some of the other markets is starting to rise now as mortgage rates have stayed higher for longer. And you've seen some of that, demand pullback and some of the slowdown in pandemic migration. And the other wild card there is, while Austin did not see an increase in resale listings in the existing market, they did see an increase in the new construction side of the market, which is a little bit outside of the data, but it does affect the existing market and does affect actives and does affect months of supply. And so you're also seeing that in Florida, where if some of those markets start to slow down and then that new construction sector and that supply continues to hit the market, you can see the active side and months of supply, especially in resale and existing, rise. And so we are seeing a lot of bifurcation across the country where we have these super, super tight inventory markets that aren't moving up, like Atlantic City, Atlantic City. I think I got that right. And parts throughout the Northeast and places like Milwaukee and a lot of places in the Midwest that have stayed very, very tight. But then you do have these other places like parts of Florida, parts of Louisiana, parts of Mississippi, parts of Alabama, Texas, and certain parts that actives have risen, and it's enough that it can increase the overall actives nationally. So we are at about 25% year over year growth for actives. And that now we're still down 37% from pre-pandemic levels. So actives are still very low, but it is going to be the number to watch, especially if mortgage rates stay higher for longer.
Josh and I often talk about having biases when it comes to things like real estate. Josh is a mortgage professional. I'm a real estate agent. So it comes off as we're always pushing the housing market in a positive way. So with this guest on today, if you're finding any value in this content that he's delivering, do us a favor and hit that thumbs up. Also, let us know in the comments if you like people like this, if you want us to do more of this type of content, to ultimately help you become the educated home buyer. And while you're letting us know if you like this type of content, do us a favor and subscribe to the channel to stay updated on everything real estate related.
With that, you had talked about some of the unique aspects of the Austin market, but as we go east through Texas, through Houston, you talked about Louisiana. You had a really good article in the last 2-3 weeks on the Gulf Coast of Florida, some of the insurance issues that you're having there. What are those all facing similar issues that are driving inventory up and prices down? Are they unique to that region? What are you seeing that we can extrapolate on the bigger level?
What has happened across the housing market, everywhere across the country, is that there was an overheating for price growth in 2020, 2021, 2022. That happened essentially everywhere through spring 2022. So we got a price shock. And then what the price shock was followed by was a rate shock. Mortgage rates went from 3% to 7%. That happened everywhere, right? So you had two very big affordability shocks that hit the market. Now, some of the markets have went and got a third one or a fourth one. Texas has seen more of the property tax shock, where there's an echo from the initial price shock. And now California, of course, you're going to see less of that. Property taxes work very different across municipalities and across states. And California in particular has very low increases for the property taxes and a very big lag from prices. But if markets see a jump up in property taxes and that takes affordability even further, or they see the home insurance shock, which is what we're seeing in parts of Louisiana, parts of Mississippi, and then also parts of Florida too, that just takes affordability even further away from historic norms. And that additional bit of a price shock is how actives rise, because it just takes a slightly bigger hit to demand And that equilibrium, it's just enough to move it in a direction where it's in a place where actives can start to build. And so, the truth is right now is we are in a fairly constrained market. Supply and demand, both are fairly low. But if you can move one a little bit one way or the other, you can start to move that equilibrium. And then, it'll be a question to see what happens in Southern California or Southwest Florida. If actives continue to rise, do they start to see more price softening and more give up? Will be that's the big question.
No, yeah, I mean, you mentioned earlier kind of the lock-in effect, and I agree with you on the lock-in effect, and Josh does as well. But there are some people out there that we follow, Logan Matashami, who basically says he doesn't believe in the lock-in effect of people, being locked into these low rates. So my question to you is, if we do see rates pull back at some point this year, next year, I'm not sure what the time frame looks like. I would have figured we would already be trending a little bit lower at this point because I thought inflation was going to come down a little bit quicker than it has. So as that metric changes, affordability improves a little bit. Do you think inventory is going to increase? Because we often talk inventory increases, but they're often buyers too. So they're a seller and a buyer.
Well, so let me jump right into that. So my view is actually a little similar to Logan's.
Okay.
But our framing is a little different. So I don't exactly believe that actives across the country are low because of the lock-in effect. Because remember, even a market like Austin saw what I consider the lock-in effect, right? They saw a decrease in the number of new listings entering the market. Mm-hmm. So my view on like Southern California is I don't actually view it as inventory being low just because of the lock-in effect. The lock-in effect to me is just the suppression of the new listings hitting the market, which has happened universally since mortgage rates went up a lot. If you don't look at actives, just take your new listings in your market and compare that to where it used to be in 2019, 2020, 2021, before mortgage rates went up. And most markets, even the Austins and the places where actives have went up back to pre-pandemic levels, the new listings is still very low. And the reason is because the switching cost is so high right now. And so if you Google the word switching cost, what you will see is the word is not just financial, which the financial side of switching cost right now for a home is, let's say you have a 2, 3, 4% mortgage rate, right? If you sold that and bought something else at a 7% mortgage rate, the difference in your monthly payment is the switching cost, right? For you personally, financially. But there's also a psychological side to switching cost, which is, and this is the part where I think the rate lock-in effect argument can be a little weaker over time, which is if it is switching cost and not necessarily a pure lock-in effect, then what that means is as people start to have more kids, or maybe their wife is like, I'm done with this house. Yep. And you got to have a happy wife, yep. Right? And so the psychological cost of not switching start to get higher, right? And so as that gets higher, that can reduce the financial cost in your own mind, where you're like, you know what? I've had enough kids. I need a bigger house, or I got a job in a different city or an offer and it's too good to pass up on. So as that stuff begins to mount, you will probably see an easing of the lock-in effect. And we've already started to see the number of new listings in a lot of markets in 2024 be a little higher than new listings in 2023. It seems like the peak suppression of the lock-in effect might be behind us. And it was the biggest right out of the gate when the lock-in effect and the switching cost was purely financial, going from that 3 to 7% mortgage rate. And over time, as some of the psychological side begins to play a role, we'll probably start to see it ease a bit. Now, the other thing that would ease the lock-in effect is if rates came down a bit, right? Because if rates came down to, let's say, 5.5%, a lot of people with a 4% or 3% mortgage rate or a 2.5%, they might be like, you know what? Trading that 2 to 3% mortgage rate for a 7 was way too much. But you know what? Trading a 2, 3, 4 for maybe a 5.5, F it, I'll do it. Agreed. So if the financial side could come in a bit from lower mortgage rates and you also start to see the psychological part of it, more kids, unhappy wife, lifestyle changes, job offers in other cities, you'll probably start to see it ease over time. Now, FHA or the FHFA, they put out a report a few weeks ago that looked at the lock-in effect, and they tried to measure it. And what they found is they believe we're essentially at around the peak for the lock-in effect, but that the lock-in effect will last for the next decade, but it will slowly ease over the next decade. And the only thing that could make it worse in their calculation is if we went up even higher on rates. Let's say we went up to 8% or 9%. And then according to their math, the easiest way to ease it would be if mortgage rates came down a point. And then if they came down 2, it would ease more. So the more rates would come in and fall, the more that that it would ease. And so according to their calculation, through the last 6 quarters, just the lock-in effect alone has cost the housing market 1.3 million transactions.
No, I agree. And I guess the question for you is, most of these people that quote, call it a lock-in effect, call it psychological, call it whatever, housing affordability, whatever we want to reference there. But most of those people selling are also going to be buying. So inventory does increase on a new listing side, but in theory, there's no net gain to the housing market.
Which is why I don't consider the lock-in effect necessarily the reason that actives are suppressed, right? I think that's a different reason. My opinion, if you want me to just give you my honest opinion on Southern California, is I think that your market is structurally underbuilt. And that's really the core reason that actives are so tight. To me, that's my personal opinion on it. And not necessarily the low resale listings. It's just, there's not enough supply to meet the demand that's there in the market.
And we see from a government perspective, you saw the big one here in the headlines recently. Beverly Hills state has said you can't issue any building permits for remodels because you haven't met your affordable housing guidelines. They want them to add 30,000 affordable units to Beverly Hills, California. So there's no irony when they say that. Like, no one should have an expectation that if you need affordable housing, that affordable housing should be in Beverly Hills. Now, just extrapolate that out everywhere. Every city in Southern California is slightly different. So there is no disagreement that we're underbuilt. But for us, Huntington Beach, where Jeb and I both live, also been sued by the state of California for not meeting their affordable housing guidelines. And you look around and you go, we're built out. We're built out. You might get an infill development where you can put 6 or 8 units in. And what their answer is, legitimately, one of the answers, we have an area over here with $3 to $4 million homes. And there's a large parcel that the owner passed away. And it's already been prepped and built more like 20 more of those houses that match that neighborhood should go in. And the state is telling the city, no, you need to put high-rise apartments in there for affordable housing. So no one ever asked for a high-rise affordable home, and that's totally separate issue here. But when we say, I agree that we are structurally underbuilt here, but we can only build out at the margins, and it seems like the state of California doesn't care about the
underbuilt is, the underbuilt doesn't necessarily, the underbuilt is just meaning that there's not enough supply there for the demand, right? That's essentially what I mean by that. And there's not a lot of supply coming on the market in single family homes, right? Whereas some of the markets that have been able to move up more on actives have some of that relief from that side of it. And if, let's say, mortgage rates came down a bit and there was more of these resale listings, well, is that every one of those people who would go sell their home, if they are not selling right now because the lock-in effect, and they decide to sell because rates come in, they are then going to go buy, right? Because the only reason they're not selling is because they don't want to get a higher monthly payment and buy something else at a higher rate. So the lock-in effect, as it eases, it brings supply and demand. And so, the question, and then on the other side is, if the mechanism that unlocks them is the lower rates, well, that also brings marginal demand, right? Of like buyers who were locked out, right? And so you can technically have a situation where, just as in Austin, new listings fell and actives rose, you could have a situation where new listings rise and actives fall. The opposite effect could happen. If the reason that this resale listings gets unlocked is lower rates.
So with that, Lance, you again kind of looking at a nationwide picture, and because listeners are all over the place, what do you think this means for house prices? You can give the projection as long as you want, a year, 6 months, doesn't matter. But just your thought, looking at a lot of data, a lot of different markets, what are you seeing?
Yeah. So my view on prices, and I try not to have too many calls here. I don't forecast on home prices. My general view has been a lot of bifurcation is likely for home prices. And that's been a view back to when mortgage rates shot up in 2022. And I thought a lot of the migration cities were going to be vulnerable for the remote work, Zoom towns, the Boise's, the Austins.
Mm-hmm.
And coming into this year, my view is essentially the markets where active listings rise fairly quickly or have a lot of actives are more likely to see much weaker or outright price give ups. And the markets that remain tight for actives are likely to continue to see home prices rise at a normal to elevated rate, depending on where actives are in the market. So I think the real key is where does this cycle take us in terms of the broader economic cycle, right? Where does the economy go? Do we have a hard landing? Do we stick the soft landing? Are we going to be in a place where even if we kind of get inflation to come down more and we do have a soft landing, are we going to be in a place potentially where rates just stay at an elevated rate for longer, but then the economy stays stable? So I think a lot of questions are what happens in the bigger macro picture of the economy? And then how does that move actives across the country? And I think actives really are the key. Now, on affordability and on a fundamental basis, we are in a place where a lot of markets are fairly strained, historically speaking. And so I think if there was a recession and a hard landing, and depending on how it all kind of played out, I think some markets could be vulnerable to give up, especially if, let's say, one thing that's true. So I just left Fortune, 6 months ago. One thing I did there is I did a CEO or a survey frequently of the Fortune 500 CEOs. And objective truth is that a lot of CEOs across the country would like workers to be in the office, not just more, but a lot more. They would like workers to be in the office more. What they do not have is economic leverage. They haven't been able to really, some places have went back, sure. But if you look at the macro pictures for the number of people working from home, it is far above where it was before the pandemic. And if you look at occupancy rates for buildings and all of that, it's really low. Or especially on a historical basis. But if we were to have a hard landing and employers were to have a lot of leverage fairly quickly, you could see a pullback there, right? And so that wouldn't necessarily be bad for the whole housing market, right? That might be good for some urban centers and markets and core suburbs, but it could be bad for, let's say, the places that are 2.5 hours out, right? Mm-hmm. Like the places that are really far out that there's just no way to do a reasonable commute. And some of these Zoom towns and some of these other places, in short-term rental communities, if we were to see a hard landing and then there were to be a pullback that's harder than expected on remote work, there could be some vulnerability to some housing markets. And, historically, the reason that the census has a metropolitan area, right? It's to measure a market for both the job market and the housing market. And the way that they calculate a metropolitan area is by commuting distance, right? And so if you think about it, that commuting distance is going from home to work, right? So a metro is really just a job market and a housing market. That's really what it is at its core. But during the initial onset of COVID-19 and that lockdown, and as you started to see people pour out deeper and deeper to the exurbs and into these Zoom towns, what you saw is a bit of a separation between labor market and job market, right? Where people could be in the job market of LA, they could be in the job market of San Francisco and New York and make that pay, and then work out in Boise or work really far away. But if you were to see the shift in the economy take us to a place where that pulls back harder, then there could be some of these housing markets that are more vulnerable than others. Now, again, this is a lot of hypotheticals because I don't know how the overall economy is going to play out. That's kind of out of my wheelhouse. And you know what? The people who it is in their wheelhouse, they've been wrong a lot. They've been wrong frequently. So I don't know how that's all going to play out. But if you were going to ask me what are the vulnerabilities in housing and where are potentially some downsides, I would say that could be it. In terms of like, if this is a hard landing, is it going to be a repeat of GFC? I doubt it. If you look at the numbers and look at, the stress in the market, there's a lack of stress on the homeowner side relative to the last cycle. If anything, the last cycle, homeowners as a pool were the weak hands. And this cycle, according to Morgan Stanley, it looks like the homeowners are actually more the stronger hands, where they're not, they're also, they're not feeling the rate hikes, right? Variable loans in the United States are very, very low. It's 90% fixed debt, 15 and 30 year mostly, whereas some of these other markets across the country or across the world, Canada, Great Britain, these other places, they have a lot of more variable debt. And so their homeowners aren't as well off. So the one part is they have very low debt in aggregate payments relative to their incomes, and it's fixed. And the other part is we have different lending standards this cycle to where the pool doesn't have as many of the people who would be more vulnerable in a hard landing situation. So I think going back to what you mentioned about supply earlier, which is if the lock-in effect eases, the people who would sell and buy something else, right? So they are supply and demand. But where you really get downward pressure on prices, if it's just, one second, I got to plug my charger in, I'm about to die, is if they sell and then they just don't buy something else, right? Like they're, a foreclosure and they're out of that house and they're going to live with their parents or a relative, or they're going to rent and they're not going right back into the purchasing market. If you get that and a huge jump up in it, then you can have the cascading declines in prices. And so I think if you were going to ask me for, downside risk, I think there is downside risk in the market in certain pockets of the country, but I think it is more isolated and less, GFC style. And by the way, while national prices decline very rarely, regionally in the 70s, 80s, 60s, 40s, 30s, you always had pockets that were falling. Like this Austin decline, this is not abnormal. What is actually abnormal is 2000 to 2007, where everywhere went up, and then 2008 to 2012, where everywhere went down, and then 2012 through 2022, where everywhere went up. Actually, what's historically more normal is 80-75% of markets going up and 20-25% or 25 to 15 going down. And I could share a chart with you guys if you want me to send it over later, which is year over year home price change for all 50 states going back to 1976. It's pretty interesting.
No, that's awesome. Yeah, that'd be great.
Yeah, that would be great. Throw it in and we'll throw it here in the show. I think a really cool way to kind of tie a bow on what we've been talking about. You've done a great job of explaining here, but also on your website in the data, that supply demand balance, that equilibrium and how that impacts everything. We have been bombarded over the last 5 years by people on social media yelling loudly that housing is going to crash starting in 2019, 2020, 2021, 2022, and they're still yelling that out. We have really smart people on Wall Street who focus on equities, who step in and they look at it and they go, fundamentally, this is 25 to 30% overvalued. It is going to crash. You recently did an article on the website that jives really closely with one of the first 10 episodes we did here of the podcast, is that home prices are sticky to the upside. It doesn't mean they're guaranteed to stay high. You just walked us through the numbers that at any given time, 20% of markets are decreasing in price. But can you kind of walk us through the big reasons why housing is different than other things that have an investment component to them?
Yeah. So let me actually pull up that story. One core part to that is and let me see if I can get it here, is that the fact there's a psychological part of it, right? Where people, they think their home's worth X, right? They saw their neighbors sell for X amount.
Absolutely.
And they're like, you know what, that's what my home's worth. And so there's a very big emotional attachment to home prices where, it just makes homeowners reluctant to sell their price, even in a situation where demand pulls back. And even if that's unrealistic, but that's just how it works. So there's emotional attachment. Two, there's just the supply demand imbalances. So if a housing market's undersupplied, it usually stays that way for years. And it's just kind of hard to change in the short term. There's an illiquidity to the housing market. Selling a house differs from stocks. You don't just open up your E-Trade or your, what do they use, Robinhood, and just click of a button sell your house. That's just not how it works. And so that illiquidity actually helps to make a sluggishness to price adjustments. Four is just inflation, right? The Fed has a mandate from Congress to have maximum employment and stable prices. And the Fed's goal is 2% inflation. So the fact that inflation is constantly increasing in the economy puts long-term upward pressure on nominal house prices, not real inflation-adjusted house prices, but nominal house prices. And then the fifth thing is leverage, where home buyers can go into the market in 2023, 2024, and take out long-term debt fixed mortgage rates, which are subsidized essentially, a lot of them by the U.S. government. And that can contribute to the stickiness of prices because the buyers can essentially spread the cost of home ownership over a really long period of time, making it easier for them to afford the prices. That, of course, can only go so far, right? If prices in some of these markets are so high. And then six is housing, unlike stocks, is a necessity. And so while there is a bit of a luxury element to housing, think second homes, maybe Airbnbs, there's a core part to it that's a human necessity, shelter. And the fact that housing is more than a financial asset, in a way, helps to put a bit of a floor to how far demand can pull back in a period of time. Now, those are the reasons that house prices relative to other assets in the economy, like stocks or bonds, are stickier. It doesn't mean they can't fall. Prices can fall, especially in a regional pocket basis. You look at New Orleans last year, or you look at Austin last year. But nationally, house price declines are historically uncommon, especially big declines like we saw 2007 to 2012.
So as you just heard from Lance, real estate is local. It all comes down to what's happening in your local market. And with that, you need a professional to guide you through the process. It's enough to have data, but it's not good enough to get you to the finish line. So if you would like to work with a professional like myself, like Josh, our team, do us a favor and check that link in the description below. Now, good stuff, Lance. So we started with a curveball. I'm going to end with a curveball here. You're a journalist at heart. What are your thoughts on journalism in 2024 and how the obsession with click impacts news coverage, impacts headlines, especially when it comes to the housing market?
Yeah. So my view on media is that I think it has a problem, which is a lack of trust. Right? There's been a breakdown of trust. And I think the economics of media, programmatic advertising in particular, doesn't help you to gain trust, right? And so I think what we're seeing a lot more of in the media landscape is a lot more people put trust into individuals, right? Or content creators or people in certain areas that talk about certain topics. And they might trust them and not be as open to trusting really big organizations anymore, right? There's just kind of been that breakdown of trust. And I think that's happened for a number of reasons. And a part of that could be what you were saying, which is the economics of it and chasing programmatic advertising. Now, the part that concerns me is I think it's great that people are going to have, a lot more trust for content creators and stuff like that. But my hope is that some of that journalistic style, right, doesn't go away, because I think there is a lot of value to. Of course, nobody does anything fully objectively, right? Mm-hmm. Pure objectivity is not real, but I do think there are that you can drift in that direction in a way that it is, helpful, especially when it comes to fact collecting. And my view is, especially people with data, is if you notice that they're more partisan, you will trust them less. So I think that even if we're going to drift into a place where it's way more content creators, hopefully some of that journalistic style can stay around, and and especially the people like myself that present data and a lot of information. I would hope that they, keep partisan stuff in check and try to be fair. But that's kind of my view on media, and that's a part of the reason that I went independent. Right, I left. I spent a decade working for these bigger publications. I had built up some trust and rapport with a core audience in the housing sector, and decided, this was kind of the time to jump. But I do think that my audience kind of understands that I approach things still journalistically, and I try to be fair and not necessarily in any one camp's, or not in the camp of any one of my audiences in particular, right? Like I'll say things that, maybe offend builders at times, or maybe offend real estate agents at times. But I think people, if they look at my body of work, they can kind of see what I'm all about and what I've kind of done and why I do things the way that I do. So I think that's where things are going to drift more.
No, that's good stuff. And I think that's a great way to segue. If you want to check out Lance's, his data, Resi Club, want to look at the inventory tracker, we'll actually throw a link in the description below where you can go and check out that service. But any parting words, Lance?
Yeah, back to the media part, which is, if you just read the news headlines on housing, you're going to be misinformed, right? I just saw a piece today from CNBC talking about how refinance applications are soaring, right? And they're taking the Mortgage Bankers Association's refi index for 1 week, right? 1 week. And they're just extrapolating a huge amount on it. Or you see the stuff about, I saw an article at the end of last year. It made me want to pull my hair out, talking about how the number of homes seen price reductions was at the highest level ever, right? And I looked at it, and they're using like some Redfin metric that only goes back to 2016, right? So it doesn't even include any real down market, right? And so you see a lot of that stuff where they just don't necessarily have the knowledge of the housing sector, or they're kind of really chasing clicks. And to be informed, you kind of got to go a little beyond the headlines. And buying a house is a big financial decision, and it's a huge sector in the economy, and I think it needs good coverage, smart coverage, very data-driven coverage that's at least a little bit objective. And so I hope that's what people get with Resi Club.
No, good stuff.
I would say, Jeb, shameless pitch. If I were in the market and I didn't know where to turn to for data, the subscription to Resi Club is pretty cheap. And just that tracker of giving you objective view into your local metro of what's happening, you still need pros. You still need a good mortgage professional. You still need a good realtor. But it is exactly what Lance said, objective data that gives a big picture view of what's happening and not clickbait headlines.
Absolutely. So if you want that info, again, it's in the description below. Lance, we appreciate your time here. Hopefully have you back on, in the near future. But until next time, guys, adios.
Amigos.
Awesome. Thank you for having me.